The market forces have two distinct periods, those of the bear and bull markets. If you want to be a truly knowledgeable investor who can prosper in both the good and bad times, you need to understand the fundamentals and history of both of these markets. In this video, we'll discuss the fundamentals in great detail, so stay until the end. Hello guys and welcome to the Market Watcher, a place for gathering traditional financial knowledge, know-how on a regular basis. Subscribe to the channel, like the video and hit the bell icon if you do not want to miss out our content. In the investing world, the terms bull and bear are frequently used to refer to market conditions. These terms describe how stock markets are doing in general, that is, whether they are appreciating or depreciating in value. And as an investor, the direction of the market is a major force that has a huge impact on your portfolio. So it's important to understand how each of these market conditions may impact your investments. A bull market is a market that is on the rise and where the conditions of the economy are generally favorable. A bear market exists in an economy that is receding and where most stocks are declining in value. Because the financial markets are greatly influenced by investors' attitudes, these terms also denote how investors feel about the market and the ensuing economic trends. A bull market is typified by a sustained increase in prices. In the case of equity markets, a bull market denotes a rise in the prices of companies' shares. In such times, investors often have faith that the uptrend will continue over the long term. In this scenario, the country's economy is typically strong and employment levels are high. By contrast, a bear market is one that is in a decline. A market is usually not considered a true bear market unless it has fallen 20% or more from recent highs. For example, if a price of a certain index stock has reached 100 points or dollars, and from this price peak it then goes to 80 points or dollars, technically speaking, we are in a bear market. In a bear market, share prices are continuously dropping. This results in a downward trend that investors believe will continue. This belief in turn perpetuates the downturn spiral. During a bear market, the economy slows down and unemployment rises as companies begin laying off workers. On the chart below, we see all S&P 500 bear markets and recoveries since 1956. The S&P 500 is the main US index which tracks the 500 largest American publicly traded companies. The blue lines on the chart express the length of the bear markets in months. The yellowish line expresses the length of the recoveries, while the light blue line underneath shows the S&P 500 index drawdowns in percentage points. The history is showing us very clearly that after each bear market, we have a larger recovery period or a bull market in other words. And in general, the bull markets are much more prolonged than the bear markets. This is usually true for all major asset classes. Since 1956, the US stock market has experienced 143 months of bear markets, while the number of bull market months or recovery months are 259, while the largest bear market drawdown from a market peak is seen during the 2007 and 2008 period, when the drawdown was 56.8%. The second biggest drawdown was during the so-called dot-com bubble, with a minus 49.1% move. And on third place is the market collapse of 1973, when the peak to trough percent drawdown was minus 48.2%. Although a bull market or bear market condition is marked by a direction of stock prices, there are some accompanying characteristics that investors should be aware of. In a bull market, there is a strong demand and weak supply for securities. In other words, many investors wish to buy securities, but few are willing to sell them. As a result, share prices will rise as investors compete to obtain available equity. In a bear market, the opposite is true. More people are looking to sell than buy. The demand is significantly lower than supply, and as a result, share prices drop. Bull and bear markets are categorized also with the investor psychology and behavior, because the market's behavior is impacted and determined by how individuals perceive and react to its behavior. Investor psychology and sentiment affect whether the market will rise or fall. Stock market performance and investor psychology are mutually dependent. In a bull market, investors willingly participate in the hope of obtaining a profit, while during a bear market, market sentiment is negative. Investors begin to move their money out of equities into fixed income securities as they wait for a positive move in the stock market. In sum, the decline in stock market prices shakes investors' confidence. This causes investors to keep their money out of the market, which in turn causes a general price decline as outflow increases. Because the businesses whose stocks are trading on the exchanges are participating in the greater economy, the stock market and the economy are strongly linked. The different types of markets are also mostly representing the economic activity. A bear market is associated with a weak economy. Most businesses are unable to record huge profits because consumers are not spending nearly enough. This decline in profits directly affects the way the market values stocks. In a bull market, the reverse occurs. People have more money to spend and are willing to spend it. This drives and strengthens the economy. Now let's summarize the main characteristics of both markets. The main characteristics of a bull market include an increase in investor confidence. With stock prices increasing, investors are convinced they'll keep doing so, so they keep buying. This further increases stock prices due to supply and demand. Companies bet more on their future. More consumer buying, businesses focus on expansions and they invest in themselves. Unemployment rates go down. With companies expanding, they hire more employees, decreasing the unemployment rate. Average wages go up as companies compete for workers. Workers are also likely to look for a job since they have a better chance of finding one that pays them more than their current job. Money is easier to spend. Increased wages mean consumers have more money to spend. After all, it feels like it will be relatively easy to get more. And that means risking excessive inflation. All that excess money can lead to an increase in the price of goods. Now let's discuss the main characteristics of a bear market, which include market panics. Stock prices are declining, marked by a 20% or more decrease from the previous highs. Decreased investor confidence is also seen. Investors feel panicked and pessimistic and do not want to invest in those market conditions. Sluggish economy is also seen during those times. Often the general economy of the country or the economic outlook isn't good. Increased unemployment is also a fact during bear markets. In times of a bear market, companies try to lower their expenses, and the easiest way to lower these expenses is with less capital expenses. Usually the first place a company cuts costs is from its labor force. We also see deflation in times of a bear market. In times of a bear market, usually all investments, services, and goods see a decrease in prices. This is due to the lack of demand, which leads to more available supply, which in turn brings prices lower. Although, from first glance, bear markets look to be only a bad thing, from a longer term perspective, they are good for the overall health and development of an economy. For example, in times of distress, a lot of inefficiencies and inefficient businesses fail, and as we already stated, after each bear market, a bull market follows. During the next upcoming bull market, new and much more efficient businesses will arise. These new businesses most of the time learn from the mistakes of the old businesses, and in the end, we, the consumers, benefit from the overall development and the betterment of those new services and goods. This was our video about the bear and bull markets. Don't forget to watch our other videos about the gold market. We have a lot of economic analysis and many other great videos that are awaiting you on our channel. Thank you for watching until the end, and I'll see you in the next video.